A very good morning to everyone. Welcome to the second CryptoCat City webinar of the CryptoCat City webinar series. And what we will be covering today will be basic market psychology. This is a re-recording of the webinar due to technical issues that we have faced in the previous live webinar. Some information about me. My name is Crypto Observer. You can find me on Twitter at crypto_obs. So I have done cryptocurrency trading for about a year, and I have some experience in the stock market and the forex market before that. So if you have anything that you want to talk to me about or ask me, you can always find me on Twitter. What will we be covering today? We'll be giving you a very short introduction about me, which I have already done, and then after that I'll talk about market psychology, and then after that I want everyone to understand what market psychology means to you as a trader, because all of us can be influenced by our emotions very easily, and if you can understand yourself, you can understand everyone else, and if you can understand everyone else, it makes you a much better trader, as you can understand how the market feels at a certain point in time. And other than this visualization of emotional sentiment, I would give everyone proper introduction on some tools which we can use to identify how price will move in the future. So before we begin, I want everyone to think about how they feel when the prices trend in a certain way. So how do you feel when your position is in profit? Do you feel happy? Do you feel sad? No, you will definitely feel happy. And how do you feel when the position is underwater? You will definitely feel fear, some sadness, and you'll definitely not be happy. So this is what I mean when I talk about predictability in market sentiment, because most traders will definitely feel a certain way if the prices move or trend in a certain way. And if you can effectively identify how you feel, or how a lay person will feel, how a normal person will feel, you'll be able to identify how the market feels and how the direction of the market. Hey, let me give everyone an old Wall Street saying: bulls make money, bears make money, and pigs, however, get slaughtered. So this means that when you're trading, you can be bullish, you can be bearish, but most of all, you should not be greedy, because greed is an emotion, and if you trade using your emotions, you will definitely lose out to people who are trading rationally. And with this graph on the left, you can see that markets are primarily fueled by greed and fear. So what this means is that a lot of the times when the price rises is not because, especially in the altcoin market, it is not because of any fundamentals, any releases coming out. It's because of greed. Let's say a stock goes up, it's usually because a company is doing well, they're earning more money, they're having more profits, more revenue, or they are having effective R&D, or they are doing some M&A. But in the altcoin market, a lot of these coins are not very useful in real life. They do not have a large impact on the lives of many people, yet their market capitalization is so high, even higher than most startups, which are really contributing to the lives of people. So if there is no tangible contribution for them to the economy or society, then how can their price go up? It's because a lot of us are actually very greedy. So what do I mean by this? It means that we are entering the altcoin market because we want better returns. And as more of us enter the altcoin markets, the price goes up. And you can see this in a lot of coins which are dead coins. For example, not. And a lot of these coins are they do not have proper use cases yet. Like they are not released out into the wild for all of us to use. They are only promises, I would say, that this coin will do something in the future. And you can really feel the greed when people on Twitter they talk about that this coin will be the new Ethereum, that this will be the new Bitcoin. Mm, is it true? Or are they just being greedy? They feel that the coin will rise up even more. So this is how you can identify greed. And how can you identify fear? Fear is when the prices go down and you know that a lot of people are in underwater when it has already done a 30% or 50% retracement even. That is when you can feel the fear and the panic settling in. Okay, just to give everyone a tip, so how do I actually identify market sentiments? I will usually go on Twitter and find the tag of a coin I'm looking at. So for example, I want to see NEO, I will type in $ NEO. If I want to see Litecoin, I'll type in $LTC, and I will see how how in general people are feeling about it. So you try to count the number of tweets which have charts and compare them to number of tweets which don't have charts but are very bullish. So if the ratio is more than about 5, it usually means that we are in the greed phase. I Not really greed phase, but more of a euphoric phase when everyone wants to grab a share of the pie and wants to earn some quick money, because it means that the market doesn't really truly understand uh, where the true value of the price, and a lot of people are buying because they just want they want to have quick returns, or they're FOMOing. And this is how I feel about greed. And to keep ahead of the game, the best time to buy would be when there's no news on the price. There's just and you search for the tag of the coin on Twitter, and the last post about the coin was about a few days ago. That is the best place to buy because it means that the greed has not started yet. Like, people are not feeling bullish. People are not feeling greedy about the potential returns from this coin yet, and this means that it will be ahead of the pack. Okay, so this means that buy the greed, sell the fear generally means that you should buy before. Like there are a few ways that people say this. Some people say sell the greed, buy the fear, but generally what important is not the order of the words, but about the underlying meaning. And this means that you should buy before the greed has started and sell before the fear has started. So you have to be ahead of the crowd. And the other phrase, sell the greed, buy the fear, the meaning of this phrase is that when people are greedy, you should start selling because you will be selling before they do. And when people are fearful, you should start buying because it means that you will be able to start accumulating before the greed sets in. Okay, so let's take a closer look at what's greed and what's fear and what is all of this about. And we can do this by going through a very simple scenario and seeing how trader sentiment dictates trends. So, how do you feel? Let's say, how does an undisciplined trader feel? Let's say if you do not know any TA, how do you feel when you're winning? Do you say this to yourself? I've got a gut feeling the price will go up even more. It's definitely going to go up. It's going to the moon, right? We hear this phrase a lot, to the moon. And isn't it a bit greedy sometimes when you already have 20% profits and you want even more? To give a comparison of how stock markets do to cryptocurrency markets, only the top 5% of stock market traders earn upwards of 20%. So if you can earn 20% in 1 week or in 1 month, you're outperforming 95% of uh, traditional traders and investors. Isn't it enough? And when you feel that you will go up even more, you want to go to the moon, to the stars, that is when you can really feel the greed settling in. And the next one, since I'm in profits, I'll stay in the trade even longer, or I'll wait for a small correction before exiting. So you feel that, okay, it will go down, but uh, you will sell it when the price goes down, when there's an obvious downtrend. But this means that you haven't set your targets prior to the trade. Without setting your targets, you will not be able to formulate a rational exit plan, and you'll be controlled by your emotions. And if you're trapped by emotions, you'll definitely lose money. Let's take a look at an example scenario. So let's say that this friend is John, and John initiates a trade with a profit target of 10% on his own analysis or somebody else's analysis. So a lot of us go on Twitter and look at someone else's analysis when we are looking for potential trades to make. And we enter a trade because they tell us that these are certain targets and these are certain stop losses, and it looks good to you, so you enter it. So let's say the prices rise and now you're in profit of 15%. So this is what John does as well. John realizes that he's in so much profit and this coin can probably go to the moon. It's probably the new Bitcoin. It may be the new Ethereum. He doesn't know. But what he thinks he knows is that the profit will be a 5-fold, 10-fold increase, and 15% is not enough for him. And he decides to let the trade run. So what is wrong with this? I put a cautionary sign here because you should always follow your plan when trading, and once you deviate from the plan, it means that you're trading irrationally without a plan, using your emotions to trade. So John feels the greed and he deviates from his plan, and because of this, he will be in a very bad position to make future decisions. So right now, position hits a resistance at 15%. This is a common scenario for a lot of the mid caps and the large caps. So what do I mean by mid caps and large caps? For the newer traders, it means that they have like a lot of coins have a certain level of market capitalization if you count the value of all the coins. And I would say that if it's larger than 7 digits, it can be considered a medium to large cap. And a lot of these coins, they do not increase 2-fold or 3-fold overnight. So this position hits a resistance at 15% and drops to 5%. And John hopes that it will rise back to 10%. So from greed, it turns into hope. So it hopes that it will recover. He hopes that the price will go back up again. Now, you find here that John is trading with his emotions already, and it's very hard to stop trading with emotions once you have started trading. And this whole scenario is can happen to you, can happen to me, can happen to everyone. And after that, the price drops even more as traders take profit, and John is now at a 5% loss, but he hopes that he will break even. So let's say the stop loss set out by the trade is 3%. It's very good. It's a 1 to 3 loss to profit ratio. It's down to 5%, but John still isn't selling yet, as he hopes that it will go up to break even. and he can at least run off unscathed and not be in a loss. He ignores his stop losses, and when it goes down even more due to profit taking and then thereafter panic selling, is now at a 50% loss. And John is very fearful that he loses even more, and he closes the position. So you see, boxes 2 to 5 represent the potential emotions that a lot of people face when they make. At the start, you feel greed when it goes up, you feel hope when your profit goes down a bit, and when you're slightly underwater, and then you feel fear. So you usually transit from hope to fear when you're slightly underwater, and when the loss is too big, you just cut everything off. This is the problem with emotional trading, is if you don't set targets, you will not be able to form a rational plan, and you will be following market trends. And you have to understand that when trading, someone wins and someone loses, and this is what we call a zero-sum game. When you're buying, someone else is selling, and when you're selling, someone else is buying. This means that you think that you're in an advantageous position and this side of the trade. However, someone else is also in an advantageous position. He thinks at least that he's in an advantageous position as well. And given a scenario, who do you think will win? Like, trading is not a love story. You win with your brains, not your heart. So the person who trades rationally will be able to win in the long run compared to the guy who trades with his emotions. To sum it up, greed will generally stop you from realizing profits. Real profits are only profits if they are realized and in your pocket. Unrealized profits are not profits at all, they are only paper profits. So you must be able to correctly identify when you will feel greed and try to control that emotion, so will be able to sell it, whichever coin that you are trading. And the second one will be that fear prevents you from cutting losses. This means that if you are slightly underwater, you fear that you will lose some money, and you do not care for the actual reality whether you will lose even more money, because you do not want to lose any money in the first place, and this will prevent you from uh, triggering your own stop loss. Now let's take a look at another real life scenario. So this, on the diagram on the left side, you see a Wall Street cheat sheet. Like, this is sort of a troll market cycle, but I find it very interesting because it can actually reflect a lot of the market cycles in the real world. So on the right, I've given you an example, NEO to Bitcoin. So here you can feel the hope, you can feel the optimism over here, and the thrill and the euphoria over here. So a lot of people, they buy in and they FOMO, and they spend all of their Bitcoin to buy NEO. And when it goes down, okay, so over here on Twitter, you guys will see a lot of tweets about NEO, how NEO is the new Ethereum, how NEO is China's Ethereum, how everyone's working with NEO, how NEO's companies are releasing uh, so many new scenarios where their product will be useful in the future. Then you think about it to yourself, is it really possible that NEO is the new Bitcoin? Is it possible that NEO is the new Ethereum? And then you buy in. And this is the belief phase. Like, usually a lot of the FOMO will happen around here. And this is when everyone goes all in, euphoria over here. So usually the market will top off when there is no more money to enter a market. So this means that the price will be at the top when nobody else who can buy this coin wants to buy this coin. Means that uh, it's at it's at the top of its price rate. This means that you will become the scenario will transform into a topping off point for the coin. And you can usually see this when, as I've said on Twitter, everyone tries to shoot it, and it's very greed fueled, I would say. So when everyone starts to take profit, people who buy at the top can feel the fear settling in. So let's say some of us who have bought here, we sell it at 0.01 Bitcoin. We are in profit. It's okay, but and the price drops. It drops even more. It drops to 0.05, 0.005, and that's when a lot of people feel fear. Like a lot of this sudden panic selling is when a lot of traders suddenly find themselves underwater, and they feel that it is too much for them to bear because they have not set proper stop losses which they can actually bear, and they end up selling all of their holdings at a discounted price, and they are making a loss. Okay, now after thinking about how it's possible for you to feel greed and fear, and how other traders can feel greed and fear, let us move into possible technical analysis tools that we can use when trading. And these tools are have a basis on the fact that human behavior and emotions are predictable and of a fractal nature. So individually, it's very hard to predict how someone will react to a reaction to an action. So let's say I put 50 cents on the table. Some of us might feel happy, some of us might feel that 50 cents isn't too much. But if you give everyone, like a crowd of people, a dollar or two or 50 cents, doesn't matter. Like 100 people, generally you can say they will feel happy, right? This means that even though human behavior is not predictable individually, as a crowd, as a mob, it is more predictable. And what do I mean when I say fractal nature? It just means that history repeats itself. What happens in the past is likely to happen in the future as well. And we can see it in a lot of chart patterns. So with the Elliott waves, you can see the fractal nature within each of the waves. So it's based on this principle that social behavior trends in identifiable patterns. So the motive wave has 5 waves, 1, 2, 3, 4, 5 over here. And each of the waves, 1, 3, and 5, have 5 waves themselves. And this is what I mean when I talk about a fractal nature. The correction wave has 3 waves, and wave 2 over here cannot retrace more than 100% of wave 1. So these are the rules that we must keep in mind when we are using this Elliott wave theory, that the wave 2 cannot retrace more than 100% of wave 1. So the end close of wave 2 should be higher, that the low of wave 2 should be higher than the open of wave 1. The low of wave 1. And wave 3 is the strongest wave, not just in price, but also in volume as well. So just a tip, when we are looking at trades, do not just look at price, we have to look at volume. Because if people buy a lot of coins at a certain volume, it means that more people are unwilling to sell their coin at a price lower than that price. If you understand what I'm saying, it means that let's say if I buy Bitcoin at 3,000, let's say the whole world buys 1 Bitcoin at $3,000 versus the whole world each of us buys one Bitcoin, buys 10 Bitcoins at $3,000. Like, this is a very simplified and bad scenario, but if people buy more Bitcoins at a certain price, it means that that price will act as a stronger support in the future. So we have to look at volume as well as price. And the last one, wave 4 cannot overlap with wave 1. So the low of wave 4 should be higher than the high of wave 1, simply put. Okay, so over here we can see Neo to Bitcoin. You can see the waves over here. 1, 2, 3, 1, 2, 3, 4, 5. Yes. And for this, you can see that even in the smaller waves, we find that we can split it down into the 5 waves as well. For each of because this can be split up indefinitely, we must understand that this is the reasoning behind this is that human behavior is very predictable. That's the reasoning behind a lot of TA as well. Much more so in Elliott waves than in price action. Yeah. Okay, now I'll talk about the Fibonacci tools and the golden ratio. So the Fibonacci tools are based on the golden ratio, and this golden ratio can be seen throughout nature and in I'll say our bodies as well. So the ratio of female to male bees in a hive is 1.618, and the ratio of the length of arm from your shoulder to the tip of your hand to the length of your arm from the elbow to the tip of your hand is also 1.618. So this is like, it seems too much of a coincidence, I feel, and a lot of theories about trading also believe that since humans are part of nature, and it means that stock markets are also part of nature as well, because we create stock markets, and we can see this phenomena in this ratio in the stock market as well. Now let's take a look at some of the Fibonacci tools. This is the Fibonacci retracement tool. So the horizontal lines you see over here in the chart indicates areas of support or areas of resistance. And how do I actually draw a Fibonacci chart? Fibonacci retracement chart. So you start off at a low and you end up at a high, and then between the low and the high you can see the retracement points. Remember, the longer the time span you're looking at, the stronger the support line, similar to price action trading. And you can also draw retracement upon retracements. So you can draw a smaller retracement chart over here and a bigger replacement chart over here. And if they overlap, like the one you see over here, it means that this is a very strong point. The more overlap there is, the stronger the support. And similarly, the more overlap there is, the stronger the resistance as well, if the support is broken. Do you guys see the mistake that I have made over here with this chart? This is a deliberate mistake, the small one. You might want to pause the video and think about it. Okay, the mistake that I have made over here would be that you should only draw a line from a local low to local high, depending whether you're looking at the candlestick body or you're looking at the high and low of the wick. So for this one, I drew it at the low, and for this one, I drew it at the close. And these are two very incomparable things. You should only start off at a close and end off at a close, or start off at a low and end off at a high. Yes. And sometimes it might feel very tempting for you to fit, to overlap or fit the tools to your liking, but it's important to follow rules because you have to see what the market uh, can let you see. You do not want to lie to yourself and see signals or support and resistance points that do not exist because it will make you enter a bad trade. Now let's take a look at Fibonacci extensions. So the horizontal lines represent areas of resistance, and this is usually used for all-time high breakouts. Because after you break an all-time high, you really do not know where the price is going. It becomes a game of price discovery, and one of the common ways to find where the price will stop would be Fib extensions. Similarly, you draw a line from a local low to a local high, and then ta-da, it's done. You can very easily see the resistance points in the future. Most of the time, you only hit the first resistance, hit the first resistance point, which is a 61% increase, and after that, it will accumulate for some time before continuing to move up. So usually it doesn't go parabolic, especially in medium to big market cap coins. Now let's look at this fan over here. So the fan lines represent support and resistance levels. This isn't a flip art, it's a fan actually. And over here we can see that the red lines represent resistance and the blue line represent support. However, we have to be aware that I do not really like this chart, because we have to be aware that over here one is very close to the starting point. The lines are very close together, and it's very likely that when one support breaks, the next one might break, or if the resistance breaks, the next one might break, and it's very hard to find a strong support. However, when we go out further out in time, you can see that they usually stick to a single band within the fan. This means that the price is of a steadier range and the support and resistance points are stronger, and this means that it's a stronger signal. So this is what I mean when I say that you should be using charts to plot um, the tools that you use to identify the future in a certain time should also analyze the past within a certain time frame. So the past over here has to be comparable to the future of a certain time frame. So this time frame over here, which is very short and broke a lot of supports, it might not be the best use of a chart which is using this time frame. Okay, so let us move on. All of us must understand that the market will always want you to commit irrational acts, and even I am guilty of this. So what happened was that, let's take a look. As new, I bought it at support on this pennant over here because it was giving oversold on the storage indicator, and it was on support on the pennant. So I set a stop loss over here if it broke out underneath the pennant and broke out to the downside of the pennant. And I would say when it broke out to the downside, I wasn't in tip-top condition trading. So everyone should not trade if you're tired, or if you are drunk, or if you are feeling angry or feeling negative emotions, or even possibly too positive emotions, because it might cause you to be over optimistic with your trading as well. So when it broke my resistance, I told myself, okay, first off, to understand, I only considered price action and the storage when I made this single trade. I did not consider the Elliott wave. So when it broke support, as in broke my stop loss, I did not trigger my stop loss. I just told myself, oh, it will go up again. And then I looked for tools which told me that it will go up again. And then I found this tool, the Elliott Wave tool. I told myself that this is the corrective wave ABC, and then after hitting this point, it will go up again. So you can see the hope that I was feeling, that I was underwater, and when it went down to this point, I felt that it could break out and go to 0.5. However, when it broke down here, I sold it at 0.006 Bitcoin. So you can see that if you don't trigger your stop losses and don't be a rational trader, you'll not be able to commit and don't commit yourself to your stop losses. You'll be losing a lot more than you had planned for. I would consider myself to be an experienced trader, and if even I can commit this form of mistakes, all of us can do so as well. So this is an example of using tools to fit the price instead of using price to fit the tools. Right? I was convincing myself by using other tools that I had not factored in previously that the price will go up, even though it was telling me that it will probably trend downwards. This is an irrational act, and this is what the market will cause you to do, right? Because it's just how the market works. Most of us trade irrationally, and we cannot do that if we want to win in the long run. And it's not just about controlling your emotions, it's also about convincing yourself that you will succeed, that your system is strong because you have already backtested it and it has been successful. So if there's a self-doubt in your system telling you that your trade might not be as good as you hope, you have to erase that emotion from your mind. You have to follow the rules that you set. If a strategy fails, so be it. But you must follow your strategy till the end. And if you don't, well, you will be taking higher losses than you have envisioned in the first place. So this is something which I have found a few months ago and I want to share with everyone. This is the psychology of a market cycle. Do not buy the top, buy the dips, and do not sell the dips, sell the tops. So we should, as I've mentioned earlier, we have to feel the market sentiments using both TA and using analysis on trader sentiments as well, like on Twitter, on Bitcoin Talk, anywhere. And we have to be ahead of the crowd if we want to earn profits. So remember, buy before the greed sets in and sell before the fear sets in. So just to conclude, market sentiments drive trends and price, and these sentiments are very predictable. As I have mentioned earlier, greed drives price to go up, and FOMO, especially FOMO, drive prices to go up because no one wants to miss out on a potential times 2, times 3, times 4. So let's say when most people buy Bitcoin, it's not because they feel that there's a future use of Bitcoin. It's because someone has told them Bitcoin has increased in 30% for the past month, and everyone wants to be part of that 30%, who wants a pie of that, part of the 30% pie. And market tools that can be used to visualize these sentiments would be like using Elliott waves or fit tools, as these are designed with human emotions in mind. And last of all, but most importantly, always manage your emotions. If you don't, your emotions will manage you. Just remember that the market is irrational and you are as well. So it's very important to identify trends in the market and with it corresponding trader sentiment as well. So to put it very simply, if you want to know how the market feels, just remove all the TA, all the lines, all the diagrams on the chart, and just stare at it and pretend you don't know anything about TA, even though it might be a bit hard for some of the more experienced traders. And think about, would you buy here if you were just starting out? Would you sell here if you were just starting out? That is how you identify greed and fear. This webinar is over, but you can contact me at crypto_obs on Twitter or on CryptoCat City Slack. Thank you everyone for watching this webinar. I apologize for anyone who has watched the original one. I personally am a perfectionist, and I was very tilted when I found out that my slides weren't showing and I wasn't able to give everybody a webinar of the standard that you guys deserve. And knowing that traits and knowing that emotions affect me a lot, I try to not put them in my trades. And it's quite interesting to see that emotions can affect you outside of trading as well as inside it. Okay, so this is Crypto Observer signing off.